Okay, ma'am. Good evening, everyone. Hope you all are fit and fine at your homes. We know that due to corona pandemic, the whole country has locked down itself. Even though the vaccination is going, we should be very careful in all its senses. The pandemic devastated all sectors as well as adversely affected the education sector. By considering the future of the students in mind, online learning method has good wide acceptance. As part of that, we are now together here through Google Meet. As we know, NTA Net Online Training Program is an initiative for UGC net coaching undertaken by the Commerce Club, Department of Commerce, University of Kerala, for providing online guidance and coaching to those who are wish to crack UGC net with JRF in this work situation. On 1st August, our online net coaching was inaugurated, and the inauguration was done by Professor Dr. Gabriel Simon Thattil, and the session was blessed with the presence of our beloved Dr. Rizia ma'am and Dr. Bijuti sir. Along with the blessings of Almighty, today we have the first session on the topic income tax and corporate tax planning, which will be taken by Professor Dr. Gabriel Simon Thattil sir. Myself, Nilayas Nair, MPhil Scholar, Department of Commerce, University of Kerala, and today I am entrusted with the duty of invite you all to this event. First of all, I welcome our resource person, Professor Dr. Gabriel Simon Settle, our beloved head, Department of Commerce, School of Business Management and Legal Studies, and the Director, IQAC, University of Kerala. Some of us know him and some do not. So I use this opportunity to introduce him to others. Dr. Gabriel Simon Tuttle is a professor in commerce who was awarded PhD in the Faculty of Commerce from the University of Calicut in 1996 for the thesis titled A Study on the State of the Art of Human Resource Management in the Industrial Sector of Kerala. He has more than 28 years of teaching experience, serving as professor since February 2010. He is an approved research guide of the University of Kerala, Trivandrum, both in Faculty of Commerce and in the Faculty of Management Studies. He has authored 3 books, have 42 research publications, 7 study materials for courses, etc. He has assisted 4 universities in their pre-NAC accreditation process, acted as academic auditor for Mahatma Gandhi University, is the coordinator for the flagship career guidance scheme for school children, My Career, My Dream. And he is currently serving as the General Secretary of Indian Accounting Association, which has 50 branches across the country, and also as the Director, IQAC, University of Kerala, and served as the coordinator for several research projects and consultancies across universities. He is a life member in Indian Accounting Association, All India Commerce Association, New Delhi, and governing board member at Center for Development Studies, etc. There is a lot to be said about him, but due to time constraint, I am limiting my words here. And I consider it a great honor to welcome you, sir. So, on behalf of me and the Commerce Club, Department of Commerce, University of Kerala, I welcome you, sir, to handle this session.
Okay, thank you.
And
Thank you, Nila, so
and it's
much.
my pleasure. Thank you, sir. And it's my pleasure and privilege to welcome you all and have a nice evening. Thank you. Over to you, sir.
Thank you. Very good evening to one and all. Because we are just having our minimum appropriate time for the session, I won't take much without much introduction. Let us directly start off with the presentation. Yeah, is the screen visible?
Yes, sir.
It is. Okay. So good evening once again and welcome back to this net session. The first, the unit number 10 that you have for your net examination is on income tax law as well as tax planning. Now it has got 4 subdivisions, and basically what we are going to cover in these 4 subdivisions is the first part is basic concepts. Then you have the residential status. Then you have exempted income, agriculture income, income under different heads, deductions under heads of income. Up to this is 2 units. Then you have deductions from the gross total income. It is GTI, not CTI. And you have assessment of individuals coming up. And then you have the corporate assessment, which is a corporate assessment, as well as tax planning and management, which is 3 and 4. So if you look at the content, it is pretty large, but then we have to see how we have to go about when we are looking at it from the MCQ perspective. So today I'm not sure how much I can cover, but if we leave something uncovered, perhaps we should have 1 or 2 more sessions in order to ensure that we are able to reach out with the good number of units in this. So at the most, we can look at part A and B. I'll try to go up to some of, at least half of this heads or half of the content today. That means we'll basically discuss basic concepts, residential status, tax incidence, exempted agriculture income, and income under different heads and deductions under the heads of income. So this is basically what we're trying to do. Headwise, again, we'll come back when we discuss set off, carry forward, and things like that, because there are a large number of MCQs which are basically oriented onto the basic concepts. So basic concepts is what we are trying to look at in a big way today. Now, I'll quickly draw your attention or make a recap of what we were looking in terms of tips and how that becomes more important when we are talking about income tax law and practice. You're all looking at MCQs, and obviously, when I'm talking about this content, you'll have to look at how you would become or how you would enable yourselves to be smart in approaching the MCQs with the content. So this is what we are basically trying to cover, because basically when you look at the content, it will all sound very simple, but analytically or inferentially, how these questions can be twisted and how those options can be addressed is what we actually need to look into. So I'm starting with some basic concepts on which we'll go a bit fast. One is assessment year, which all of you know, which is given as a basic concept there. Now, you are not going to write descriptive statements here, so you're going to be very precise on it. It's a period of 12 months. It starts from 1st April in 1 year, and it ends on 31st March in the next year. So basically, it's the financial year. So MCQs can be, how does assessment year match with the financial year? In the current year, how the taxations can be. So the current assessment year is 21-22, which has started from the 1st of March 21 and which will go up to 31st of, which has started with the 1st of April 2021 and which will go up to 31st March 2022. So the current assessment year is 1st April 21 to 31st March 22, which is very simple. And then I'll tell you what is going to be a bit twisted over there. And the next concept will be the previous year. So the previous year is basically a period of 12 months, which is just preceding the assessment year. So if you say assessment year is 21-22, previous year will be 20-21 and just preceding 12 months. So for the assessment year 21-22, the previous year will start on 1st April 20 and end on the 31st of March 21. So that's the previous year. Now, what is more important is what we are seeing after that. Income earned in the previous year is taxed in the assessment year. So you will be asked questions in this form, which is the year of earning. The year of earning is always the previous year, and the year of taxation is the assessment year. So for the year 21-22, for this assessment year, you will be filing your returns. That means your taxation is happening in terms of what happened in the year 2021. So year of earning is 2021 and the year of taxation is 21-22. If your year of earning is 21-22, its taxation will be in the year 22-23. So this is one thing which you should keep in mind. And we have something in India which is the uniform previous year. It was not so until 89-90. So remember that it was only from the year 1989-1990 that we moved on into the uniform previous year. So across India, currently, we always have assessment year to be 12 months, which is the financial year starting from 1st April in 1 year and ending with the 31st of March in the next year. And throughout the country, we have a system where the previous year is just preceding 12 months. But this started only in 89-90, and before that, we never had uniform previous year. Now, what does that mean? This means that before 1989-90, the previous year was the accounting year which ended in the 12-month period preceding the assessment year. Once again, I'm repeating, it was the accounting year. For different SSCs, they'll have different accounting years. For some, it will be the calendar year. For some, it was 1st July to 30th June. So you could have different accounting years. So you take the accounting year and you take preceding 12 months from the assessment year, and the accounting year which ends in that preceding 12 months was the previous year. So say, for example, suppose a firm follows, or suppose an individual follows the calendar year as the accounting year. So calendar year, you always know, it starts from 1st January and ends in 31st of December. So imagine the current assessment year. The current assessment year is 21-22. And 12 months preceding that is 1st April 2020 to 31st March 21. So you take the 12 months preceding, and in that 12 months preceding, the accounting year is 1st January 20 to 31st December 20. So that was the previous year. Now for some other firm, if they are following the financial year, they'll have the financial year as their previous year. And for another firm, if they are following 1st July to 30th June, that will be their previous year. So previous year could vary according to the accounting year. And you take the accounting year which precedes the assessment year and you fix the previous year. So this was a situation where the previous year used to vary. Anyway, after 89-90, remember the year because that was the year when we had a uniform previous year. From this year onwards, 1989-90, we always have previous year, which is the financial year immediately preceding the assessment year. So for it is uniform for all forms of SSC and it is uniform across the country. So these are the basic concepts of assessment year and previous year. Now we go on to charge of tax under section 4. These are some basic concepts which we can quickly go through. One, we have an annual tax. This is an annual tax. It's not a monthly tax or a weekly tax. It's an annual tax which you pay for assessment year. Number 2, this annual tax is actually a rate. The rates for the taxation is fixed by the Finance Act. This was once asked in the your MCQ question, which is where does the income tax rates get fixed? The income tax rates are never mentioned in the Income Tax Act. It's mentioned in the Finance Act. And the The Finance Act gives these rates which get stabled on the 1st of April of every year. And it is this rate which is given by the Finance Act which gives you the rate of taxation. It's not given by the Income Tax Act. Now, suppose it's not given in the Parliament. The Finance Act is not given in the Parliament on the 1st of April, again for your MCQ. Then what will be the option that is left with the SSC? You can take the rates which were there in the previous year. So this, suppose in 1st April 2021, the Finance Act is not giving the rate, then the SSC can go by the previous year's rate or the rate which is to be introduced and take whichever is beneficial. So it's not always that you go by the previous year's rate. Keep that in mind, again for your MCQ. You have the option, the SSC has got an option to follow the upcoming rate or the previous rate, whichever is beneficial for him in terms of the total taxation that comes up for him. But this is only in the case where the rates have not been specified. If the rates are specified, the rate of tax will be as given in the Finance Act. And remember, it is not the Income Tax Act. And again, your tax has to be paid on the total income. Now, there is no distinction whether the income comes from legal or an illegal source. But obviously, there are no chances of income from illegal sources being accounted for. Because the Income Tax Act says you must record and give all your income, including income which you have derived from illegal source. Suppose you get income from theft or income from smuggling or income from dacoit, some kind of smuggling of arms and things like that. These are all income which you get through illegal acts. So you must show the total income. But the problem here is if you show all these incomes under the Income Tax Act, your total income might be right. But under some other act, maybe the CRPC or some other act, you might get, you are likely to be penalized or punished. So on that count, normally there is no chance of there being illegal income being accounted for. But the income tax says it is total income, which is legal as well as illegal. Tax is on every person. So here there is something which you need to keep in mind. You need to understand the concept of person, the concept of individual, and the concept of SSC. Now, person is a wider term and it includes individuals. But a person has with it an artificial person also. So person can be an individual, person can be a firm, person can be an association of person, it could be a body of individuals, it could be a corporate entity, it could be a local authority, it could be an artificial person. So one among the person is an individual. So person is different from individual. Individual is a natural living human being. Clear? So there is taxation of individuals and there is taxation of other persons. In your curriculum, I found you have taxation of individuals under the heads of income and you have taxation of corporates. So these two things are included. So we are looking, whenever we say SSC, we are talking about an SSC to be a person, not as that person can be an individual, a firm, an AOP or BOI or even a corporate. So we are talking about taxation for a person. And SSC means, SSC is somebody who is liable to pay tax under the Income Tax Act or against whom some proceedings have been taken under the Income Tax Act. So it's not always essential that you should be liable to pay tax. So imagine, suppose your income is very low and you believe that you are below the taxable limits. So you do not file a return. But if an assessing officer feels that you're not disclosing your income and maybe a best judgment assessment or some charge has been imposed against you, and after that, subsequently, you might prove that you have less income or you might be caught for having high income. But a proceedings has been initiated. If the income tax officer or the assessing officer initiates a proceeding under law against, saying your MCQ, plus any person against whom some proceedings against or some proceedings under the Income Tax Act has been initiated. So either you are liable to pay tax and you do that, or you are not paying tax, but some proceedings have been initiated against you. So in these two contexts, you become an SSC, and a person can be an artificial entity as well. So this is with regard to the provisions for charge of tax under Section 4. Now, income. This is very important. Income under Section 224. It is inclusive. Most important thing for your MCQ. It is inclusive. It's not exclusive. When you say inclusive, it means that under the definition of income, there are certain listed items which will call for taxation. And all those things together, all those things included together, or all those things put together will become what we call income. And this comes under entry. I'm giving you this again for your objective type. What is most important there is the 7th schedule of the Constitution, entry 82, list 1 of 7th schedule of the Constitution. That is what gives the list of items which are put, and under that there are certain things which are said to be exempted. For example, agriculture income is exempted. Now, if you look at the definition part, it talks about this in this form: a periodic product of one's work. So one's work is one source of income, or it could be one's business, or it could be something which comes from investment, which is yet another source, or it could come from land or animals. So periodic product of all these things. There is also another way of looking at it. It is an increase in wealth of a person during a stated period of time. So this is how the definition goes. So we need to know that it is inclusive. It is as given in a particular schedule, and this is how it comes. And there are certain things which are exempted from this. And it is by and large on an accrual basis. So that is very, very important. You have a receipt basis and an accrual basis, which you see in your accounting part. It is not only those incomes that you receive that will make you liable to tax. It's also those income which you are liable to receive or which is due to the SSC, which will make you liable for tax. So say if I am entitled to get salary, and I do not receive that salary, I'm supposed to pay tax for that salary unless I surrender the salary to the government. So also, if I am entitled to get income from house property and give my house property on rent, or I give it at a lower rent than what is entitled to me, even then I am entitled to pay tax on a due basis, which you will see when we try and look at the different heads of income. So it's accrual that is more important, the accrual concept, similar to what you have in terms of your accounting concepts. There is a link between this in terms of profits and gains from business and profession, perhaps one part of which we'll discuss today, but whole thing we cannot discuss today. In accounting, what we discuss and what we see, I'll put that towards the end after looking at the basic concepts which we need to cover for today's session. Again, basic concepts. Keep this in mind. This is again a question which was asked. There is a concept called diversion of income and another concept called application of income. So what do you mean by this? Diversion actually means income received by a person other than the person who is entitled for it, and the recipient later diverts the same under a title. Now look at this, I'm once again repeating it. Income received by a person other than a person who is entitled for it. That means a person gets some income, but that person is not fully entitled for that income in terms of a title. By title, that income should have gone to somebody else. And the recipient who gets it subsequently diverts or transfers it to the person who has a title for it. So very simply, it is like this. Somebody gets an income for which that person is not entitled. He receives it and later transfers it to the person who is entitled to receive it. This is called diversion of income. So what does that mean? I'll just give it through an example. And this happens in several cases. Suppose I make a joint publication in a journal for which the publisher gives me some income. And they fix the income as 20,000 rupees for the publication. I hope I've made myself clear. You have 20,000 rupees for this publication. Now, this publication is not my work. It is my work along with a co-author. So myself and the co-author, together we publish, and we are told by the publisher that we are going to get an income of rupees 20,000 for this publication. So I tell my co-author that we have done this together. So I will not take this amount in full. I will share it with you, and you are entitled to get half of it because you are the co-author for it. So this is how the title goes. The income that comes will be shared between the two authors on a 50-50 basis. So I'm telling him I'll give you 10,000, I'll take 10,000, and this is how the sharing has to go. But the publisher will normally give it. Now, when I'm getting title to 20,000, I'm entitled only to 10,000. And I've also agreed to transfer the other 20,000 to my co-author. Now, I received this 20,000 knowing well that I'm not entitled for 20,000. I'm entitled only for 10,000, and that there is a co-author who's entitled for the remaining 10,000. I receive the 20,000 and I give this 10,000 to my co-author. This is called diversion of income. I'm diverting income because the person who gets it is not entitled to it, and there is somebody who is actually entitled to it. And there is also an agreement that this is how it should be shared. So you get it together and you share it with the person who is entitled. Now look at the next sentence, what I've given over there. Tax is payable by the person to whom it is diverted. What is diverted is not taxable in the hands of the person who gets it. In the example that I gave, I received 20,000. But if there is a diversion of 10,000, even though I received 20,000, I'll be taxable only for 10,000. And for the remaining 10,000, person to whom it is diverted, my co-author, he will be taxed. Clear? So what is diversion? So this will come for your MCQ. If at all it comes in for MCQ, it will be through examples. So if there is a prior agreement, a prior title on sharing, and one person gets the full amount, and subsequently he shares based on the title, then he will be taxed only for his part, and what he diverted will be taxed in the hands of the person to whom it is diverted. This is called diversion of income. But this is different from application of income. Application of income means, again, one person gets the income, but there is no prior agreement on sharing, or there is no prior title. After getting the income, for which he is entitled, there is no other person who's entitled to that. But that person says, after getting that, subsequently he used it for different purpose. I'm saying that I got 20,000, but I paid 10,000 to my assistant who's my salaried employee. Or I paid 10,000 for some charges, and therefore I have only 10,000 left with me. But this is not based on a prior title. And I'm just saying that subsequently I spend some amount for different purposes. In that case, there is application of income. There is no diversion of income. And tax is payable by the person who gets the income. If I get 20,000 and I'm saying 10,000 I gave as salary to my assistant, that 10,000 cannot be adjusted because it's application. It's application of income. It's not diversion. So I'll have to pay on full. I hope you have understood the concept. So as far as your MCQ is concerned, in application of income, the income which has been diverted or transferred for other purposes will be taxable. The total income will be taxable on the person who originally gets the income. There is no claim that is possible for diversion that has taken place. Whereas in the case of diversion, the diverted part will be taxable only in the hands of the person to whom it is diverted. But the concept must be clear. You have to decide whether it is diversion or application. Diversion comes only when the recipient diverts it under a title, and he says that I'm not entitled to get this full amount. I'm taking it in full, but I'll be subsequently giving it as per a title deed for it or a title agreement to it. That is what is happening here. In case of application of money, the case which went off was in fact a case from Kerala, which went up to the Supreme Court in terms of a priest. And what happens in many charitable institutions and the priests and nuns and all, they work for institutions, they get salary. But based on their vocation that they have taken up in the form of priesthood or nuns and all, they have to give their entire salary for their order or their charitable institutions, and they live on a very small amount. But this is not what the court said was, it is not actually a diversion, but it is just they are giving their amount for some other purpose. So it's application of money. So this is the very important concept of diversion as well as application of income. Now, again, there is deferred income. Deferred income is also taxable. So diversion, application. So when you are diverting, the diverted part will be taxed only in the hands of the person to whom it is diverted. But when there is application, full amount will be taxed in the person who gets the original amount. Deferred income is also taxable. What do you mean by deferred income? The income which is due on a particular day, I'm saying that I will take it only after 6 months, or I'll take it only in the next year. So I'm just deferring that income. I'm postponing the benefit that I'm getting to a future period, but it is due to me in a particular day. So I can't say that I didn't get it, I deferred it to another day, another year. So this year I didn't get it. This year you are entitled to get it. So even if you defer it to another period, it will be taxable. Pin money is, sorry, there's a small spelling mistake there. Pin money is